Hello and welcome back to the Wall Street Petting Zoo. This week, Robert, we had a short trading week because Monday was President's Day, and so we had a 4-day trading week. The first couple trading days of the week, the market moved slightly higher, and on Tuesday, the S&P 500 hit 19 forward PE for the first time since 2002, meaning stocks were now more expensive than they had been in 18 years. Basically, the market is priced right now as if there is no risk in the market, when in fact there's lots of risk from coronavirus and from record high debt. So on Thursday and Friday, we finally got a bit of a correction as the market moved sharply down.
Yeah, part of the reason the market moved up early in the week was good economic data. New York State posted much better than expected manufacturing numbers, and we also saw a slight uptick in home building. We also got a little bit of bad news on Tuesday when the producer price index came in higher than expected, meaning the price of wholesale goods has increased. The reason the market dipped on Thursday was because a couple of analyst firms published dire warnings about the impact of coronavirus. S&P Global announced that if the coronavirus doesn't go away by April, the mass shutdown of businesses in China may cause over $1 trillion of corporate debt to go into default. And Morgan Stanley announced that its analysts think the market is underestimating coronavirus's economic impact. Thursday, we did get more positive economic data, however, including a better than expected manufacturing number for the Philadelphia region and a positive read on an index of leading economic indicators.
Yeah, so we got some good regional data on Philadelphia and New York manufacturing. And we also, got some just kind of general good economic news. But overall, I think the market is starting to realize that coronavirus is a serious threat to the economy. That uptick in the producer price index basically as a result of, quarantines causing cheap supply to be cut off. So producers are having to go elsewhere and buy a little bit more expensive products in their supply chain. So it's costing a little bit more to actually produce goods now. I think this is going to be bad for earnings in the future. And I think that this may just get worse as sort of the quarantine zones expand and as the quarantines drag on. So we do have the potential to see, a lot of companies, either businesses get completely disrupted or their overhead go up significantly as they have to shift their supply chains around. Friday, the market tanked even more than it had on Thursday, partly because of coronavirus, which we'll get to in a minute, but partly also because of economic data suddenly turning negative. Most of the economic data reported this week was from January, and it was pretty positive. But on Friday, an analyst firm called IHS Markit reported a preliminary read on February's economic data, and it doesn't look good. According to this report, not only is manufacturing in decline in February nationwide, but also the services sector contracted for the first time since 2015. Tech stocks FANG, that's Facebook, Amazon, Apple, Netflix, and Google, led the way down for most of the market, including Microsoft.
Here's something else I saw this week. Lots of negative guidance on companies' earnings reports. There's now a long list of companies that have warned investors about the potential negative impact of the virus. Even Domino's Pizza, one of the few big winners from this week's earnings reports, warned that some of China's locations are closed and the rollout of new stores in China will be slower than expected due to quarantines. I'd go so far as to say that now is not a good time to be playing earnings reports because even stocks that beat expectations for the last quarter may issue negative guidance about the next one. As for the actual number on the spread of coronavirus, there's a lot of confusion right now. If you recall, last week we saw a slowdown in the number of new cases, followed by a big spike as China adopted a new method of counting diagnoses. This week, the numbers slowed down, apparently partly because China went back to the old method of counting cases. So this week, it looks like the virus has slowed down again, but with several different accounting methods being used, it's really hard to say.
Yeah, and actually, the latest I wrote some of that stuff about coronavirus yesterday, but the latest data point shows it speeding up again. So it looked like we were adding about 500 cases a day for the last few days, but then yesterday we added like 2,000 cases again, 1,500 cases, something like that. So it seems to be, potentially speeding up again. We'll see what happens this week, but I suspect that the market will be down on Monday because investors will see that sort of spike over the weekend in new coronavirus cases. And it looks like it may be getting out of control in some countries like Iran and South Korea, which would mean that it's no longer contained to China and there's a real risk of an international pandemic. Outside of China, however, the virus is also getting traction in a few countries. As I mentioned, Iran and China. Iran announced Friday that 11 people had died. This was sort of the first indication that there was a significant presence of the virus in the country. And they also warned that the virus may have already spread to every city in the country. So in Iran, they've had an outbreak of the virus that does not look like it's contained right now. And on Friday, South Korea announced that there had been an outbreak of at least 40 cases at a church in the city of Daegu. Kind of fun. The church is called the Church of Jesus, the Temple of the Tabernacle of the Testimony, which I had to remind myself that I'm not allowed to be amused because coronavirus is bad. So even if the epidemic in China seems contained, the risk of a global pandemic may be increasing. And that's the main reason that the market tanked on Friday. And I expect that to continue next week. I think that we probably are seeing the beginning of a very significant correction in the S&P 500, especially since we topped out at 19 PE on Tuesday, which is kind of a critical technical level. And I think the market is going to be real shy about moving above that. And with all of the earnings guidance across the market moving down rather than up, I think that we're going to see prices move down as well. So let's talk stocks that we watched last week. Robert, what'd you watch and how to do this week?
All right, so this week I watched Jack in the Box. They failed to meet analyst expectations and fell 3 points Thursday morning, but by the end of trading, actually on Friday, had actually recovered from the 3-point loss. So even with all the bad news, especially with coronavirus, appears to have almost no effect on Jack in the Box. But I did some digging into the state of Jack in the Box, and they are in the midst of a transition period for their management team. So in December, the CEO announced they are stepping down, and 3 other executives will also be leaving. They also sold off Qdoba, a Mexican restaurant brand, which were not set up as franchises like Jack in the Box, which could mean higher profits without Qdoba dragging down their finances. They also sold off their San Diego headquarters and will be moving locations near their test kitchen at a fraction of the size. So I believe they're going from like an 8-acre real estate down to about 1.5. So they're really reducing their footprint in terms of size of their headquarters. These moves seem to indicate that a long-term play for Jack in the Box would be a good one, but again, with all the coronavirus news, I don't believe there's a lot of impact with them specifically, but again, with the overall economy, they may get dragged down along with it. Vulcan Materials was another stock I was watching. They dipped after missing expectations, but did report a profit gain of about 7% year over year. The company is in good shape despite dropping 2%, which means a good buying opportunity. And Hormel Foods dropped nearly 2% after the company announced it would be purchasing Sadler's Smokehouse. Sadler's Smokehouse is a family-owned restaurant chain, and Hormel's buying them so they can add their barbecue lineup to their food. So typically when companies announce large acquisitions, the stocks do go down as there is a fear that the acquisition will eat into profits due to integration costs and increases in overhead.
Yeah, so last week I watched OneMain Holdings, Blucora, and Viacom CBS. OneMain Holdings roughly broke even for the week. I think that it's probably poised to move higher, but with the market moving down, I suspect that it will be dragged down along with the rest of the market. Whereas if we had even sort of like a break-even week in the market, I think that OneMain would probably move higher. But I think just about everything is going to be dragged down this coming week, probably as the market falls. Blucora started this week strong, and then it fell and ended the week down 3.5% with the rest of the market. And then Viacom CBS had an absolutely terrible week after reporting misses on both earnings and revenue and issuing terrible 2020 guidance. thankfully, I read the earnings report pre-market and I realized how bad it was. The stock was down about 7%, but I saw that the guidance was down about 13%. So I knew that there was more downside ahead. So I sold my stocks pre-market, and good thing because it ended the week almost 20% down after this earnings report. And it probably won't start to really recover until it launches its new streaming service, which may happen sometime later this year. I expect Viacom CBS will probably remain pretty weak, basically because its earnings have declined now, or are expected to decline now year over year rather than to grow. So essentially, this is a depreciating asset for at least this year. So, Robert, what stocks are you watching this coming week? You watching anything?
This week I'll be watching Home Depot. And as I noted last time they reported earnings, the stock usually dips after earnings and then recovers slowly and then grows past the dip. They report earnings on the 25th before the bell. So I will look to purchase on the 25th, but I also will see how they report on future guidance. So if they report that based on coronavirus, if they see, the business not doing so well, that same trend where they normally recover after earnings may not be there. So I'm going to read the transcripts or try and listen on the call for Home Depot if it's I don't know if they have an online call like with other ones, but that's what I'll be waiting on with Home Depot. And then although Zoom doesn't report until March 4th, I'll continue to watch the stock, as I did mention after the last earnings report that the stock would go from $50 to $100 by the end of the year. And here we are only 2 months into the year and the stock already breached the $100 mark. I think this may cause a pullback after the earnings report, but I think the stock will continue to rise up until the first couple days of trading in March. And then we'll probably see a huge sell-off, and the stock may come crashing down to probably the $70 or $80 level. But I believe it will recover back to the $100 mark by the end of the year. Other than that, I've just been watching the taboo of the investing world, the cryptocurrencies. I have some money in Bitcoin, Litecoin, and Ethereum, as the volatility of crypto is good for buying low and selling high. I don't encourage people to put a lot of money into crypto, but I am making the gamble that it is smart to have some money in it. Don't put your life savings in it.
Yeah, cryptocurrency is one of those safe haven currencies, so it tends to do better while the market is down. So that's probably not a bad bet. Gold also should do fairly well this week as the market falls. Honestly, I'm almost completely out of the market right now. I don't like to play the market short, so I don't usually buy puts or inverse funds. I used to play gold a little bit, but I got burned a few times on gold as well. Given that the market usually goes up on average, I think that basically if you're playing the market short, then you are betting against the house. You're playing at a disadvantage. So you might get lucky and you might win, but on the whole, you are playing at a disadvantage, and I don't think gambling at a disadvantage is a good idea. So I am out of the market. I'm mostly in cash, and I'll be looking for sort of re-entry points to go long on the market at some point, but it may be a while before that happens. I wouldn't really recommend playing earnings right now because of how they're being impacted by coronavirus. I actually got burned on a couple things this week that I thought, okay, these companies are relatively safe because they do business almost entirely in the United States and Canada. And then on their earnings reports, it turned out that their supply chains are in China, even though their markets, their customers are in the US and Canada. So they ended up being impacted by coronavirus anyway. One example of that is Superior Group, the Superior Group of companies I had bought calls on ahead of their earnings. They absolutely blew away analyst estimates on their earnings. It ended up being, just a total earnings beat and revenue beat. But they also said on their conference call that, their business may be disrupted if there are interruptions to their China supply chain. And, they don't really know what's going to happen with that. And so the stock spiked a couple of times on Thursday and Friday, but then it came back down both days because investors are realizing, oh, there's this risk from China, from coronavirus. So I'm seeing that, pretty broadly a lot of across the market. Even a lot of the companies that I would think don't have a lot of China exposure turn out to have some China exposure after all. And so I think this is just a really risky thing to do, playing earnings. But if I were going to play earnings, here are the ones that I would choose. Callon Petroleum and WPX Energy. Both are extremely cheap companies right now. They're U.S. oil producers, oil and natural gas producers. And I think they both have a small chance of announcing their first ever dividend on their earnings report this quarter. WPX already announced that it is going to initiate a dividend this year as soon as it completes an acquisition. So we don't know when that's going to happen. But sometime this year, they should be initiating a dividend. And whenever they do, I think that share price is going to spike. Even if they were to miss on their earnings and their revenue, that share price would spike on the initiation of a first ever dividend. So also, Callon Petroleum just completed a merger with Carrizo Oil and Gas. I don't know if that is going to lead to them initiating a dividend or not, but it could, because they now have sort of extra scale and free cash flow and so forth. And sometimes companies, after completing a merger, will initiate a dividend. So I think that those are possible beneficiaries. Usually when a company initiates a first ever dividend, it goes up not just on the day of the dividend initiation, but also keeps going up for quite a while. So I think there's a lot of potential upside from those two earnings reports, especially if they were to initiate a dividend. If coronavirus continues to slow down next week, that would be great for oil prices, which would be good for both of these companies. And also, we got news Friday that Houthi rebels tried to attack the Saudi Arabian oil conglomerate Aramco with Iranian-made drones. The Saudis stopped the attack, but it's possible that conflict in the Middle East may heat up again, which again would push oil prices up. So there are some reasons for oil to potentially go up this week. But as I said, coronavirus is speeding up again, so there's a real risk that actually oil prices will do the opposite. They'll go down again as a result of coronavirus. So, I mean, of the bets in the market, I think this is one of the better bets out there right now. But, it's really a toss-up. It's 50-50 either way, which way these ones will go. The other one I might play, if I were going to play earnings this week, is Foundation Building Materials. All the data on housing and construction lately has been pretty good, which I think bodes well for Foundation Building Materials to beat earning expectations for the last quarter. It only sells goods in the U.S. and Canada, so coronavirus shouldn't impact its sales. But again, I'm not sure how much China exposure it has in its supply chain. I think usually building materials are more produced domestically. I mean, you're getting your lumber and your gravel and so forth more from like Mexico, places like that, than from China. But it's possible that it has some China exposure. I don't really know. So kind of a toss up there as well as far as how coronavirus might impact Foundation Building Materials. But I think it's probably one of the safer bets this week in the market on earnings reports. Alrighty, Robert, anything else to say before we sign off here?
Yeah, just because some stocks may not, you may even know that the stock may have no China exposure in the supply chain management, but at the same time, you got to remember a lot of investors invest emotionally, so they may drag down the stock with like that. Their stock may trade with the rest of the market and trade down. So even if the stock doesn't have that exposure, it may just be a victim of, in wrong place, wrong time.
That's very true. And also a lot of people are trading ETFs, which broadly hold a lot of different stocks. And so, if a lot of stocks are down, people may start dumping their ETFs, and that could drag down, the entire index, even if an individual stock is fundamentally sound and financially strong. So you probably will see some sort of spillover even into relatively safe stocks from broad market weakness. And, especially people now are playing ETFs with like these leveraged ETFs where they're basically day trading ETFs that have like 3 times leverage. So their day trading is amplified 3 times. So, there's definitely a lot of risk from sort of broad market weakness. And overall, I would just say stay in cash. That's the best thing to do until all of this blows over, in my opinion. One thing, though, that people could do to make a little bit of money right now, Robert, is there is a promotion on Webull where if you deposit $25,000 into a Webull account and leave it there until early April sometime, you can get 25 free stocks on Webull. And they have tended to give stocks that are a little bit pricier than Robinhood. Robinhood, I think, is giving like under $5 stocks. Webull has been giving away a lot of like $10 stocks. So, potentially you could get like $250 free basically for depositing $25,000 into a Webull account over the next month. That's pretty fair rate of return. And in addition, I would suggest that you use our referral link underneath the video to open up your Webull account. That'll get you 2 extra free stocks as well, just to sign up and deposit $100 into your account. So even if you're not going to deposit the full $25,000, you could deposit $100 and get your 2 free stocks. Hey, free money, So go do that. Support our podcast. Give us a like, share, or comment on YouTube if you like what you've heard here. Share it with your friends. Tweet at us on Twitter. Like us on Facebook. And thanks so much for listening and for supporting the podcast. We will see you at the zoo next week.
See you.